Hello, this is Rochelle Agatha, and this lecture is on income taxes, unusual items, and investments in stocks. And once again, this is a more complex set of accounting topics, and for beginning accounting, which is what we're in, I really just want to stress the most important thing to this lecture is just being able to understand that there are journal entries that corporations have to do related to taxes on their books. Here we go. Our objective is to journalize the entries for corporate income taxes, including deferred income taxes. Describe and illustrate the reporting of unusual items on the income statement, prepare an income statement reporting earnings per share, and describe the concept and reporting of comprehensive income, and describe the accounting for investments in stocks. Okay, the most important part, as I mentioned in this lecture, is really being able to journalize entries for corporate income taxes. Most corporations are required to pay estimated federal income taxes in 4 installments throughout the year. Corporation estimates its income tax expense for the year to be $84,000. The first of 4 estimated payments is journalized as income tax expense debit, credit, cash. Okay. Then here's an example of different types of rates that companies pay from a corporate tax standpoint. So you can see that corporations, as we mentioned in the previous lecture, have a disadvantage that they're taxed as a separate legal entity. Some differences between taxable income and income before income taxes are created because items are recognized in one period for tax purposes and in another period for income tax statement purposes. These differences are called temporary differences because they reverse or turn around in later years. Examples of temporary differences are revenues or gains are taxed after they are reported in the income statement. Expenses or losses are deducted in determining taxable income after they are reported in the income statement. Revenues or gains are taxed before they are reported on the income statement, or expenses or losses are deducted in determining taxable income before they are reported in the income statement. So basically, things are either reported differently on the income statement and the tax return on an expense side and a revenue side. Some examples are tax depreciation methods are different. So there's a tax method called makers versus straight line on your books. Don't get too hung up here. Just keep in mind it's an overview of knowing that there are these temporary differences. So as you can see here, straight line is the same every year, but makers is kind of like a double declining balance. So it's higher in the first years and lower in the second years. But at the end of the 5 years, there's a total. So they are the same at the end of the 5 years. At the end of the first year of operations, a corporation reports $300,000 of net income before taxes. With a 40% tax rate, the firm faces a tax of $120,000. So it's just $300,000 times 40%. That's a lot of money. Using tax planning, the net income is reduced by $100,000 and the actual income tax due is $40,000. Now, this isn't a tax class, so don't worry about where they got that $100,000. Just take it for face value. So the entry to record income tax reflects the deferred amount of $80,000. So they have income tax expense of $120, income tax payable of $40, and deferred income tax of $80. So they know they're going to owe it, but it's going to be owed in future years. So it's not payable. I want you to make sure you understand the difference. The 40 is payable now, the 80 is payable later. The whole thing is an expense now. Just because you defer it doesn't mean it's not an expense. If 48 of the deferred tax reverses and becomes due in the second year, the entry will reflect that fact. Deferred income tax payable and income tax payable. That is really the key to this lecture for beginning accounting. A corporation has $200,000 of income before income taxes, a 40% tax rate, and $130,000 of taxable income. Provide the journal entry for the current year's taxes. So here you go. Income tax expense for the full amount. The payable is $52 and the deferred is $28. So then you have income tax expense, shows how it's calculated. The differences, there are also permanent differences. Differences between taxable income and income before taxes reported on the income statement may be the result of differences that are not timing differences but are permanent differences that never reverse. Interest income that is exempt on municipal bonds is an example of this type of permanent difference. So that's an advanced accounting topic, and that's about all we're going to say right now. Describe and illustrate the reporting of unusual items on the income statement. Unusual items subtract from gross profit in determining income from continuing operations. Things like fixed asset impairments or restructuring charges. A fixed asset impairment occurs when the fair value of a fixed asset falls below its book value and is not expected to recover. Examples of events that might cause an asset impairment: decrease in market value, significant changes in the business or regulations related to fixed assets, adverse conditions affecting the use, and expected cash flow losses using the fixed asset. So we're going to do a journal entry for this company where they had a loss on fixed asset impairment of $750,000, and they have, you take the equipment down, you actually reduce the equipment. So here's how you report for unusual items on the income statement. It shows up after gross profit, before income from continuing operations. And it shows up on the income statement here also as a loss from asset impairment. So you can see it's just adding to the corporate income statement, and it has a spot. So it's a high-level accounting topic. Just want you to see it from an overview standpoint. Reporting unusual items on the income statement. Unusual items subtracted from gross profit and determining income from continuing operations are restructuring charges. So once again, we had fixed asset impairments. Now we have restructuring charges. Those are costs incurred when actions such as canceling contracts, laying off, or relocating employees, etc. So a restructuring charge, we're going to do an example. Jones Company communicates a plan to terminate 200 employees. The restructuring plan calls for a termination benefit of $5,000 per employee. Okay, so we're going to book the fair value of this plan would be $1 million. 200 employees times $5,000. So you would have a restructuring charge of $1 million and an employee termination obligation. So you have an expense and a liability. 25 employees find employment elsewhere and leave the company. So you pay those employees. So on March 25th, you're going to reduce your termination obligation and pay them. So here, once again, they're showing you that restructuring charges sit where fixed asset impairments are, under gross profit, before income from continuing operations. There's an example. So we're going to do another example. Toro Corporation determined that the equipment had been impaired. So you can print this slide out and make sure that you understand that it's a loss on fixed asset impairment actually reduces the equipment account. It doesn't go into accumulated depreciation. It goes right against the actual asset. And then there was a restructuring charge and an employee termination obligation. Unusual items may also include discontinued operations, a gain or loss from disposing of a business segment, which is going on a lot in the economy right now. Companies are restructuring and dumping off lines. Auto companies are dumping off certain lines of their business. That's called discontinued operations. It shows up after income from continuing operations, before extraordinary items. There's another example. And then you have your extraordinary item is another unusual item on your income statement. Your extraordinary items result from events and transactions that are significantly different from the typical or normal operating activities of the business and occur infrequently. That's the definition. So here's another example. Unusual items in the income statement, once again, fall after income before extraordinary items. As you can tell, I'm kind of going through this a little quicker than most chapters, only because I just want you to see it. Once again, it's a more high-level accounting topic that's delved into greater and advanced accounting. There could be retroactive restatement. In addition to unusual items impacting the income statement, there are two major items that require retroactive restatement: errors in the recognition, measurement, or presentation of the financial statements, and changes from one generally accepted accounting principle to another. Okay, so if you decide, those are actually called unusual items, and those, as you can see here, are reported. Just keep that in mind. We're not even going to do some examples on that one. The third objective is to prepare an income statement reporting earnings per share. Once again, I'm just going to go over this as a high level. The profitability of companies is often expressed in an earnings per share ratio. If there is no preferred stock, the earnings per common share is net income divided by number of common shares outstanding. If there is preferred stock, it's net income minus preferred stock dividends divided by the number of common shares outstanding. And here's an example. Okay, so I'm going to let you go through these slides when you print them out. We're not doing any homework per se, but you need to just kind of look at it, make sure it makes sense. The fourth objective is to describe the concept and reporting of comprehensive income. Comprehensive income is defined as all changes in stockholders' equity during a period except those resulting from dividends and stockholders' equity. Other comprehensive income items include foreign currency items, pension liability. So the cumulative effects of other comprehensive income items must be reported separately from retained earnings. So here's what it would look like: net income, other comprehensive income, total comprehensive income. Very high level accounting topic. Just make sure you've seen it. When you take advanced accounting, you're going to go through it in greater detail. Here's an example for you. I'll let you print the slides out. Objective 5 is to describe the accounting for investments in stocks, and this is a little bit more in line with what we've talked about a couple times. Individual businesses have a variety of reasons for investing in stocks called equity securities. So a business may buy stock of another business, and that's actually called an investment. Trading securities are securities that management intends to actively trade for profit. Available for sale securities are securities that management expects to sell in the future, but which are not actively traded for profit. When a business invests in available for sale securities, such as investments are classified as temporary investments or marketable securities. Marketable securities must meet 2 conditions. The securities must be readily marketable and can be sold for cash at any time. Management must intend to sell the securities when the business needs cash for operations. So here's an example of a company purchasing marketable securities for cash. Okay, so it's an investment on your asset section of your books. And then on October 1, the company declared 90 cents per share on that investment. So they get cash and dividend revenue because they hold that stock or that investment as an investment. So they get the dividend revenue as a business. On the balance sheet, temporary investments are reported at their fair market value. Any difference between fair market value and their cost is unrealized holding gain or loss. So here's an example. We kind of did this on the asset side, same sort of thing. Lower of cost or market gives you your unrealized gain or loss. And this is what it would look like on your balance sheet. Here's another example of a company that the end of the period market value for the investment was 110, net income was 180. So they're asking you to show this in an example. So here's your initial cost, and your unrealized gain less your tax on the unrealized gain is your net unrealized gain is your reported amount of marketable securities. Okay, so you show it at the cost plus the gain. And then you had net income plus unrealized gain less tax on unrealized gain, is 21,000. So you had net income in Part B of 201. So just as an overview, just looking at some of the more high-level accounting topics, long-term investments are not intended as a source of cash in the normal operations of a business. Rather, such investments are often held for their long-term gain. That's why they're long-term assets. So you ask yourself, is there a significant influence over the investee? No. Then you account for the investment as an available for sale security. If yes, you account for the investment by using the equity method. So on January 2nd, Howley Inc. pays cash of $350,000 for 40% of the common stock of Brock Corporation. So it's investment in Brock for cash, purchase 40%. For the year ending December 31, Brock Corporation reports net income of 105. So the investment in Brock Corporation, and they got 40 per share, 40% of the net income. On December 31, Brock Corporation pays $45,000 in dividends. So they get their percent of the dividends. So here's just kind of a diagram of what we just did. There's a lot of rules around companies investing in companies and legal entity status, minority share. I don't even want to go over that in this class. It's an advanced accounting topic. This is just the overview of what happens if you buy into another business. Okay, so here's on March 1st, the Dre Inc. had a carrying amount of $15,700, is sold for $17,500. So there's actually a gain on the sale of that investment. And then here's another example. Phillips Company purchased 30% of the outstanding stock of Sing. So we'll go through that example real quick. So you had your 30% of the $90,000 less the dividend is your increase in investment in Sing Company. There's a little bit of financial analysis in this chapter. The price-earnings ratio, just so you can see it, it's net income divided by common shares is your earnings per share of common stock. And then you take your earnings per share of common stock and you divide it into your market price per share of common stock, and you get your price-earnings ratio. The price-earnings ratio represents how much the market is willing to pay per dollar of a company's earnings. So as you can see, here's just another example of the 2 years compared. It went from 12 to 15 between the 2 years, so it's increasing. The price-earnings ratio indicates that a share of common stock was selling for 12 times the amount of earnings per share at the end of 2007 and 15 times at the end of 2008. So in summary, the most important part of this chapter was really understanding that corporations pay income taxes. You have to book a liability when on the books for that. There are permanent and temporary differences that cause tax liabilities. If you're going to move on outside of this class, you'll take corporate accounting, you'll take advanced accounting, and you'll spend a lot of time in this area. So if you feel like I just did an overview, that was pretty much the point for beginning accounting. And if you have any questions, let me know. Thanks.